we just integrated with is Project Zero. Instead of arbitraging needing to put up the capital twice, you can put up the capital one time and use that as collateral for your other trade. That makes everything way more attractive, and the kind of amount you need to make on it a lot lower to make it attractive. So, Zen BTC, we launched as kind of one of their launch partners, and there's an incentive program right now to kind of bootstrap liquidity on the platform. So it's worth checking out.
Actually, I still think it is probably one of the more interesting things to think about is like, what will the landscape for on-chain trading as well as kind of like trading in general look like in 1 year with all these people launching their own perp dexes? I mean, like you can even break it down into like, should it be its own chain? Should it be its kind of like, composable ecosystem built on another L1? Like what's going to be like the landscape of on-chain trading and activity in a year? Because like with what we're seeing right now, like in terms of how like quickly, some of the volume and open interest and like some of the activities actually spinning up on these perp dexes, regardless of if it's just being farmed or if they stay there, et cetera, like mercenary liquidity, all of that stuff popping up. It'll be super interesting to see like, is Hyperliquid still number one in a year? Like I would lean towards most likely still in a year, but like it'll be super interesting to see who's number two and like who else is competing in that space for sure.
Welcome to episode 8 of ZR Talks. We're here today with Chris Newhouse of Ergonia. Just a quick disclaimer at the beginning. Ergonia is a market maker for Zenrock across products, and nothing we say here is financial advice or anything like that. So with that, Chris, how are you doing?
Doing well, man. Thanks for having me.
Of course. So maybe it'd be good to just hear a little bit about kind of your background and how you even got into crypto in the first place.
Yeah. No, I can definitely give you like the whole spiel here. So I got in 2017, so ICO bubble. That was pretty much back whenever I was in college as well. So instead of studying for finals, I was trading Litecoin on Coinbase.
Smart.
And so that was, GPA obviously suffered, but personal account did pretty well. That also was like kind of like my first foray into crypto ever. So it was kind of like I was trading Ripple and Litecoin and just all of these like boomer coins that we see kind of now still popping up in the fray and things like that. But yeah, that was kind of like the initial foray. A little bit of background as well. So previously I was a trader over at Genesis on the option side, trader over at GSR on the option side. Did a very brief stint as a quant trader on a natural gas desk at Chicago Trading Company as well. So that was kind of OTC broker style trading, but also kind of like a little bit more systematic and electronic as well. So kind of like watching and managing like an electronic eye in terms of kind of like what the market microstructure there was for natural gas. Like obviously being a commodity, that is definitely, super interesting. It was very like over the phone broker style stuff as well. Went to Georgia Tech College. I was a, computational biology major, quantitative finance master's, founder of Georgia Tech's blockchain club, founder of Georgia Tech's, quant trading club. And then I was very active in Georgia Tech's VC club as well.
Dude,
you guys went to Emory, right?
Yeah, I went to Emory.
Atlanta
Both Jack and I went to Emory in Atlanta. I was the founder of Emory's blockchain club in 2017. So look at that.
There you go, man. Founders of the blockchain clubs getting together.
A few miles away. We should have done a podcast back then, 2017. That's awesome. So just to understand a little bit more, like, what exactly is Ergonia and how does it fit within like the larger like DRW kind of entity, and I guess what are your like goals as a company?
Yeah, so Ergonia is kind of, we're backed by DRW and Cumberland, completely separate entity, and we are the essentially on-chain trading arm. So we are massive, also like to be specific, we are massively focused on the Solana ecosystem as a whole. So we've like co-built with several protocols. We've built out our own infrastructure. We will go into it later in the podcast as well. We've built out the prop and dark AMMs, and I'm sure we'll talk about that landscape as well. But massively active on Solana, not only just on-chain trading, but also TVL deals, minting and redeeming, like very bespoke DeFi stuff as well. So like in some of these things that these L1s or and this is not necessarily only Solana, but across DeFi as well. Some of these DeFi protocols will come in with these like requests for proposals or like these RFPs where it's like, hey, we have a very bespoke ask for someone. How would you structure this? How would you price this? And how can you help us?
Yeah.
And so essentially it's not necessarily like, okay, cookie cutter token market making deal, run an Excel spreadsheet. Here's the price. Here's what we're going to charge. Here's the loan ask and things like that. It's more like, okay, how would you think about charging us for this? What kind of services are you going to be providing? Like, is this going to be, are you supposed to be running a vault? Are you going to be doing some sort of secondary market liquidity provision? Are you going to be market making on the token? Are you going to be doing like minting and redeeming? Like, hey, we need TVL in this lending and borrowing protocol. It's different from the ones that everyone else is doing, but this is something that's new and we want it there. So it's very, very bespoke stuff. And essentially like that's one of the strengths of Ergonia is like, hey, we come from obviously like the traditional financial background, but these are like DeFi degens in the trenches.
Yeah,
like
right.
These guys are like some of the best and brightest in terms of like combining traditional financial like market structure education and knowledge with just like DeFi degens from the trenches. And so it's kind of like, you know, these guys have been playing around with like all the DeFi protocols. They were all involved in DeFi Summer. They have like high frequency trading expertise and backgrounds as well. But obviously like that on-chain expertise also. And so kind of like for us at Ergonia, so I'm head of business development, I kind of lead like the client facing initiatives. So it's more so going out to protocols like yourself, going out to different L1s and like looking and sourcing some of these like RFPs in terms of like very bespoke DeFi deals. For us, we don't necessarily think of, you know, the DeFi business as just like a, hey, one and done, like we're market making your token, so yeah, we're gone. It's more like, hey, how can we structure a deal to like get very, very actively involved with you guys, just from like a headcount perspective and time management as well. We're very small. So it's actually better for us to kind of work, you know, very, very closely with 5 or 10 people instead of like have 100 different Telegram chats, all just market making a token and sending dashboards every day.
Right.
So that's how we think of it, as more of a holistic strategic partnership with the people that we work with.
It makes a lot of sense. Why'd you guys choose Solana in the first place?
Yeah, that's a great question. And I'm going to ask you the same thing. In terms of why we chose Solana, like Solana, I would say from my perspective, from our trading perspective, just from a lot of like the active DeFi traders in general, I'm sure they all have the same perspective. Solana is kind of like that one L1 blockchain, or that one blockchain in which being a, you know, architectural expert and having a deep understanding of the market microstructure on Solana actually gives you a massive competitive advantage. So it's not like, you know, the MEV landscape of Ethereum in terms of where you can just like bid for blocks and things like that. Obviously you have GTO and BAM and all of that stuff. But like the way that you can, you know, it's very similar to the traditional financial markets in terms of like massively optimizing for things. So whenever you think about like things like compute units, and like we'll go into it with prop AMMs in terms of how these are like, they have these highly specialized and very optimized compute unit based, you know, compute units for their Oracle updates, things like that, like how that gives market makers advantages in terms of their prices. It's very, very similar to like the options market makers in terms of like the high frequency trading and low latency of, hey, let's just go co-locate with the servers and we'll be right next to them. We'll have like a latency advantage and things like that. So in terms of like why we were active on Solana, that's probably one of the reasons, or I know that that is one of the reasons initially. Second of all, it was kind of like a concentrated bet on our end that really, really ended up paying off in 2024. Obviously, like Q4 of 24 with all the meme coins, all of the activity there and things like that. That was one where it was like, okay, like Ergonia has massive product market fit in Solana in terms of like the trading systems we've built out, the, you know, infrastructure we had in place, the custom integrations we've done with several different, you know, aggregators and order book kind of style liquidity provision. And for us, that was just kind of like, okay, as soon as we saw that we were doing pretty well on that, we also had just a great tailwind of Solana doing well itself. And so that was kind of like a key sign of, okay, let's double down, let's triple down. And now a lot of the stuff that we focus on is massively on Solana. I'm sure we'll be on Hyperliquid, Monad, et cetera, et cetera. You know, the fast EVMs and things like that, anywhere where the trading activity and volume is. But yeah, Solana for us has been first and foremost, and we're looking to, you know, do these more holistic partnerships with people building on Solana. And so a question for you guys is like, why did you choose Solana for Zen BTC?
Yeah, I could chime in and then Jack go ahead, but definitely aligns with your reasoning as well. We wanted to align a Bitcoin asset with a layer 1 that has massive network effects in terms of liquidity, cheap fees, and fast blockchains in terms of transactions. We did, you know, initially when we were thinking about where we wanted Zen BTC to exist, we did speak to a myriad of different L1s, you know, move-based L1s, layer 2s on Ethereum, and also different applications in ETH L1 as well. And the reality is that throughout these conversations, we kind of got stuck after the second call on governance and like the real like DAO oriented models that a lot of these protocols had or applications had in terms of actually supporting a new asset like a BTC Fi asset that is coming onto their chain and needed approval from multiple different stakeholders in order to actually like get support for it. And the other thing is that they had a lot of requirements for liquidity and 24-hour or 7-day volume in terms of just general support. But once we spoke to many different Solana dApps and then also Solana Foundation itself, there was a clear mission to really become kind of this everything exchange, I would say, in terms of supporting tokenized assets, supporting Bitcoin, obviously, and then this is coming off of the tailwinds of the meme coin craze over the course of 2024. And we really liked and enjoyed a lot of our conversations with applications on Solana, like Camino, like Drift, etc., that were really focused from day one on supporting the issuance of assets like a Bitcoin asset or a tokenized asset. And it was just, frankly, much easier conversations in terms of like BD. And I know that's a very macro, oriented comment, but it was very important to us as a project that was just coming into the on-chain ecosystem, coming into DeFi, and made it our home. And since we launched in August, ever since we've built up that foundational liquidity, protocols have been reaching out to us actively. So the entire network works very well in terms of creating an effect of supporting newer assets, working together, moving fast, breaking things. And I think that overall mission really aligned with myself and also the team to really go in balls deep into the ecosystem.
Yeah, I'd add also to that, just this culture of creative destruction on Solana is so strong, right? It's like people you speak to, they're really excited about new things. They want to see your project succeed, it's not easy starting a project from zero, right? And when you have kind of this whole community around you that really feels like they want you to succeed, and a lot of people who realize hey, if Zenrock builds a massive product on Solana, that's going to benefit us, that's going to benefit all of our partners, and it's going to grow the pie for everyone. And I'm not saying that culture doesn't exist on other chains, but I feel like it's so strong on Solana, and that's, I think, a huge reason why we wanted to build there.
100%. And I mean, from my perspective as well, you guys kind of hit on it, the composability and kind of the accessibility that you have to all the communities on Solana, is a very unique thing, I feel like. And that's something that, even whenever you look at crypto 2021 onwards and things like that, in terms of some people splitting off to go build their own app chains for their own perp dexes and their own order books and things like that, it's kind of okay, well, you're probably going to start losing out on composability and things like that. And that's something that you definitely have to think about in terms of not only distribution, but kind of getting a lot of the product. Well, it is core just distribution as whole, and I think that Solana is probably one of the most composable but also accessible ecosystems in terms of reaching out and meeting new teams.
100% agree with that. And I do think you mentioned this briefly about tight-knit teams early on, just going into your background, and I think we saw something that was very important in terms of working with a very tight-knit team. Solana Foundation is a very small team that's really on the core mission, one mission of developing and supporting the Solana ecosystem. But we've seen time and time again that the fish rots from the head up, and you see that come down, trickle down into all of the applications that are built in a layer one ecosystem. And they kind of have that same mindset of bureaucracy and things are a little political, blah, 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 whatever it is. But, I think working with a very tight-knit team and making sure that everyone has clear ownership and alignment over a core mission is something that really aligned with us, because we're not in it really for the short term at all, right? We see Zenrock 10, 15, 20 years down the line of being a core, fundamental, canonical protocol in the on-chain economy. And we're starting that with ZenBTC on Solana, but that can grow to many different things. We may not even know where it goes to, right? So building out the core liquidity network effects bridges your protocol or asset to multiple different avenues within the on-chain economy, which is becoming extremely diverse as we speak.
Yeah, I think that's exactly right. One question I wanted to get into, as we dive more into this market structure topics, I think it's so interesting, and I think that there's so many people who kind of would assume that making markets and doing these sort of kind of trading operations in DeFi is just pretty much copy and paste the traditional world. And from talking to a lot of people, I know that really couldn't be further from the truth. It's a totally different beast. So kind of, I don't know, I'd be curious to get your take on it, having sat in both those seats. What's the same? What's different? What's people maybe not understand?
Yeah. I mean, first and foremost, market making is, buying on the bid, selling on the ask. And so you do that 100 million times over, you profit a couple of cents every trade, and, that's the business. And that's kind of like, I'm trying to think about it just from the analogies of traditional finance as well as thinking about it on DeFi. Also thinking about it from different chains as well, because we're speaking about Solana. Ergonia is very focused on Solana. We've done some trading on EVMs. You guys are speaking about Solana. The market microstructure across different chains, like even L2s like Arbitrum and stuff on Ethereum, like very, very different. One of the biggest things about Solana that makes it unique is like it's a very aggregator dominant landscape in terms of there is one central aggregator that is very much so dominant, and it's Jupiter. And so in terms of kind of like thinking about it from that perspective, like one of the most interesting things that's kind of happened here is like, hey, if all the flow is going through a central aggregator, not necessarily through some of the front ends, like it really opens up, some very, very creative ways to start providing prices to retail users or even institutional users at the end of the day. I guess honestly, this is a question that you break down into several points. Like you can go into the, hey, like what do you think about AMMs versus CLOBs? What does the AMM versus CLOB versus dark prop Oracle inventory AMM landscape kind of look like? Or like if you think about it from, what does on-chain trading, like you kind of asked us already, it was like, what does on-chain trading versus, traditional market making look like? I mean, from my perspective, one of the biggest things about on-chain trading is you're constrained by like the blockchain limitations. Whenever you're doing traditional market making, like these people are thinking in, not necessarily 400 millisecond block times, they're thinking way, way, way quicker than that. In terms of like data access, data availability, co-locating with servers, co-locating with like exchanges and things like that. So execution quality and kind of like thinking about best execution is very, very different in both of those, because like you are not necessarily constrained too much in traditional finance in terms of like, I guess you are in terms of how quick you can actually trade. But on Solana and on the blockchain, you actually are constrained literally by the blockchain. And so whenever you're constrained literally by the blockchain, like you start thinking about all these creative ways to eke out that little edge. And so like one of the different things about, Solana is obviously it's very high throughput, it's low latency, it's very low fees, but it also has like a very bespoke kind of structure in terms of like how the Solana scheduler and how transactions are ordered and how transactions actually end up landing, and how you can like look at the next leaders and validators and things like that make it like I was saying earlier, Solana is like one of the blockchains where being an architectural expert and fully understanding the market microstructure gives you a massive advantage. Right. And so like whenever you start thinking about, okay, like we were just talking about, okay, so I'd say like some of the similarities between, traditional finance and on-chain market making, like it's just, buying on the bid, selling on the ask. And like, that's kind of where it ends. I was gonna say it's kind of where it ends. Like there's always like the thing of, okay, there's the fair price and your theoretical values and things like that. Like a lot of the some of the most interesting stuff whenever you start to think about the trading firms who have entered the space, either the traditional trading firms who have built out their crypto arms or kind of like the crypto native shops, is like at the end of the day, like trading is trading. And so some of the strategies that people are using, like at least in the earliest times, they were literally just porting over some of their analogous kind of like market making and kind of like, quant research and things like that to crypto. And since it was a lot more inefficient market, there were just opportunities to pick up pennies in front of everyone. Like money was just sitting there and people were just picking it up, especially very early on. But like moving into, I'm kind of going off on a tangent because there's just so many different things to talk about. But kind of as the market microstructure started to evolve, you started to see a little bit more sophistication in terms of the participants entering the market. Like, well, actually, now that I think of it, you can even break it down into CeFi versus DeFi trading. So obviously, like there was the traditional market, thinking about traditional versus crypto. But even within crypto, it's like, okay, CeFi versus DeFi trading. And that's like where you start to, really get to narrow down some of the differences as well. Like being able to trade, on a venue like Binance versus being able to market make on, some of these different DEXs is very, very different, especially with the on-chain stuff, right? Because like you're constrained by the blockchain again. So you could probably ask some more questions to focus it, but yeah, that's just me hitting like 6 at a time, maybe. No, there's so much here. It's a really interesting topic. I think like one thing just maybe quickly to hone in on is like, I think this idea of, hey, it's not just about who can offer the best price and kind of who can show the most like offers, whatever. It's also like who can understand how these blocks work the best, right? And like who can kind of build blocks most efficiently and kind of squeak out MEV in all of these different places. Because then, if you can find a ton of ways in terms of like the block building to eke out some
gains, maybe you can give better pricing and then win a massive percentage of the bids.
Exactly, and that's kind of like what happens in terms of like some of these prop and dark AMMs. We'll go into it a little bit more detail, but like some of these, Oracle inventory AMMs, like it's essentially vault-based liquidity that has a pricing oracle. And like one of the biggest advantages of being a highly, like, bunch of professional market makers are running these. And essentially one of the things that you can do to optimize your pricing on these dark and prop AMMs is have a highly compute unit efficient Oracle price. It allows you to update your prices, significantly more times in a block, et cetera, et cetera. And then obviously, like if you have the most, updated price, like you're able to provide, markets around the most updated price. And so like that's one of the ways where people are kind of thinking about like this optimization of an on-chain problem that allows them to actually quote tighter and better and more efficiently. And so like that's something to where like you start thinking about it. It's like, okay, I mean, we actually hit on like, why did people choose to build on Solana? Like one of the things as well is just like the developer talent here is very good.
Crazy.
Like they decided like, okay, it seems like everyone decided like, okay, this is the chain that we need to be building on. And then you start talking to some of like the devs at some of these shops and you're like, oh my gosh, like, these guys came from traditional financial institutions that are very good at high frequency trading. And they just decided like, okay, Solana, Rust, C++, like this is my, advantage. This is my skill set. Solana is able to really take advantage of a lot of that. And so like in terms of on-chain developers, talent as well, like I feel like that is 100% reason why Solana is also like a very interesting ecosystem to be building any product on.
Yeah, without a doubt. The developer talent cannot, like you cannot say enough about it. And I think that it's all the same thing, right? It's like people want to build, people want to help you build. If you're someone, you're looking at the landscape, it's like, oh, well, these guys want to help me build. Like, why wouldn't I build there? Maybe let's talk a little bit about like CLOBs and where that fits in, right? Just in terms of like way of history, like the automated market maker, essentially, where a liquidity provider funds two assets into a pool, and then kind of those assets get used to fill orders both ways. The user could then pull the assets out and have a different ratio potentially. That's kind of the risk. You get paid for that. That's like the traditional model, and kind of really what broke through and made DeFi work, right? Because before that, you couldn't consistently get orders filled at prices that made any sense. So the AMM was like this massive innovation, right? And kind of became the bedrock of liquidity for the entire DeFi landscape. I think what's really interesting is now on top of that liquidity, since there is that liquidity there, people are finding more and more sophisticated ways and kind of going back to a limit order structure in a way that it wouldn't have been possible if it wasn't for the AMM. So it's kind of interesting evolution of on-chain trading. I'm wondering what that looks like from your seat.
Yeah. I guess from my perspective, like you kind of hit it off, initially is like the AMMs 2020 DeFi Summer, Uniswap, et cetera. Like these were like financial innovations in terms of being able to build like a feature set and product that was kind of like, oh, it's super easy. I just go to Uniswap, I click swap, I trade two assets, XY equals K. Like at some point, like, it's relatively easy to do small size, small orders, and I can play around in DeFi. Like that's how I got some of my first airdrops is like, all right, go to Uniswap, swap some tokens, get like very small size and just go play around with a bunch of different DeFi protocols. One of the interesting things to note is like, while that might be like a very interesting way to provide liquidity in small size, like as soon as you start thinking about the institutional products, institutional DeFi, like that's also another question is like, do you think institutions will be coming to DeFi to act like, no, like will people be going through, on the traditional institution side, not the crypto native institutions, like, the Wintermutes and Ergonias and GSRs, et cetera, but like the, the BlackRocks and stuff. Like would they actually go to Jupiter and hit, like, I don't know. And so that's something to think about as well in terms of like down the line. And so like, like you're saying, initially start off with the AMMs. Like it's a great way to provide like very small size, what you're going to get filled at. It's like relatively easy. But then once you start thinking in terms of like the complexities of being able to provide like more institutional liquidity, you start thinking about it in a way of maybe passive versus active liquidity in terms of like, whenever you post assets on an AMM, it's passive, right? Like you're depositing both sides of the pool and it just sits there.
Yeah.
And so there's this concept of, loss versus rebalancing or impermanent loss. And that is kind of what sways away like institutional liquidity providers to actually quote and provide assets there. Like we're also kind of like in that ballpark of, hey, we don't want to take an LVR like impermanent loss hit on some of these volatile assets. Like for stablecoin pairs, it's very different because they're like stable coins.
Yeah.
But for volatile assets, like professional institutions and market makers don't necessarily want to take impermanent loss hits and things like that, which prevents like pools from being incredibly deep. But yeah, initially, like you start out with this very passive liquidity. It's not necessarily concentrated across any range. It's just there.
All right.
Then you start to see kind of innovations in terms of like the concentrated liquidity market making, in terms of which, Uniswap V3, you can provide a range. And so that was like a massive improvement in terms of like liquidity around the most active traded prices, instead of just having, idle liquidity just sitting there at, plus 40% that's actually never going to get utilized or traded against. So that's how I think of AMMs. You kind of initially had, just full scale liquidity provision across the entire spectrum. Then you start to have like the concentrated liquidity market making as well. Obviously, like the institutional liquidity providers, like for them, it has always been about the CLOB. It has always been about like, hey, this is an order book structure where we are able to see kind of like, this level 2 order book data. We're actually going to know what we're, getting filled at, et cetera, et cetera. Like, sure, you could do some XY equals K and stuff like that, but there's no impermanent loss and stuff for the CLOB. You don't just sit there passively and provide, liquidity and you have the ability to kind of like pull it out whenever you want to, put it back in. It's more active, right?
Yeah.
One of the things as well about AMMs, like to think about is like, with that impermanent loss and kind of like with the LVR and things like that, the way that, those initial tokens were allocated was to subsidize the impermanent loss. It was kind of like, okay, if you LP here, we're going to give you a bunch of tokens. These tokens are worth something. You should be able to sell them and that'll cover the impermanent loss.
Right.
And that's not necessarily solving the problem of impermanent loss. Like maybe it's solving the financial constraint of, hey, I'm not going to, sit here in a pool and lose money. But it's not really ever going to solve impermanent loss. And so in terms of like thinking about the market microstructure and evolution, traditional financial institutions, you want deep liquidity, it's going to be in the CLOB style. They're like very familiar with that.
Yeah.
And I'm sure we'll hit it later as we can talk about kind of like the dark and prop AMMs and things like that. In terms
that was
of like,
my next question on top of that, because I think it's a great segue. I mean, you guys have done a lot of work building your own proprietary tooling to enable more efficient market structures and DEX structures. So maybe you could talk a little bit about like open book to the extent that you can share what you built at Ergonia, building really on top of this, I would say, legacy DeFi market structure that we have today.
Yeah. So I mean, we kind of had like a custom integration with OpenBook in terms of like, and then we've also iterated, beyond that as well. We have our own dark and prop AMMs. Obviously not public yet. Maybe will never be, or maybe it will be. There are obviously some market makers who have theirs public as well. And so there's obviously like pros and cons to that, things like that. But also like to get into the structure of like why these are called prop AMMs or dark AMMs or Oracle inventory. Like that's 3 ways to kind of, skin the cat in terms of like, those are the 3 different ways to describe what I'm describing here in terms of like some sort of vault-based liquidity that a market maker or professional institution holds inventory in and has some sort of Oracle-based pricing. I think Elfinity in 2022 was one of the first to do this Oracle-based liquidity and things like that. In terms of like Oracle AMM, that was kind of like the first one. And then obviously kind of like, Ellipsis Labs, they iterated with SolFi and things like that. But those are 3 ways to describe the same thing. And essentially these prop or dark AMMs, like I said, it's vault-based liquidity that someone is holding inventory in. They get their, pricing updates via an Oracle. And these, like the market structure here is like these are directly integrated into Jupiter as an aggregator. And since Solana market microstructure is so focused and so aggregator dominant, like this is where a lot of the trading actually goes through. And so why did this market structure come to evolve and be the way it is right now? Like if you trade Sol USDC, like Sol USD, Sol USDC, et cetera, like if you do that through Jupiter, there's a high likelihood that you're going to get filled better than Binance. And it's because like of these prop and dark AMMs. And like one of the things that has allowed this to happen is like the way that, you can actually selectively be quoting against Jupiter in terms of like, okay, if someone wants a quote or a price and it is someone who is expressing like high frequency trading tendencies or doesn't look like, non-toxic flow, you don't have to quote against that. You don't have to trade against that. Whereas like, okay, even in a CLOB like one of the things in terms of like why Hyperliquid, had like a big advantage there is like market makers are, heavily prioritized in terms of like how, Hyperliquid itself was built. And so like one of the ways that kind of has iterated over to Solana is like these dark and prop AMMs, like they're very much so built with market makers in mind in terms of like what is the ideal flow that a market maker would love to trade against? Non-toxic flow. Like you do not want to be trading like market maker versus market maker.
Yeah.
You don't want PvP. Like that's absolutely the worst. It's two well-informed counterparties, well-researched, et cetera, et cetera. You don't want to trade against that. And so if you can isolate that, and you're only trading against non-toxic flow, then like that's how the pricing, competitiveness starts. Because now it's like 6 prop AMMs competing all for the same non-toxic flow, and it just ends up being a race to zero in terms of like the compression of the spreads and the ability to provide that liquidity. And so it's like, it's an aspect of, okay, if we all know that it's kind of like very similar, maybe not too similar, but the same sense of kind of like a payment for order flow model in terms of traditional finance. Like that you are about to get all of this like very non-toxic retail flow. And so it's kind of a war to win that. And so that's essentially what it has become in terms of Solana right now. All of these prop AMMs, especially for the larger pairs like Sol USDC, everyone knows the flow that's coming into the aggregator and that they're quoting is non-toxic. And so they're kind of in a race and war to bid against all the other professional market makers to get that flow for the cheapest price.
For sure. So
it makes a lot of sense.
Yeah, so much there. So do you think that every chain, like is Solana just ahead of the curve? Like, is it that like if we look at even ETH1, like in a few years, as like it's going to get here? If not, like what is the structural reasons why we're not going to?
Yep, that's a great question. ETH1, there's no way, I don't think. Like the reason that this is dominant on Solana is, first of all, like you can think about it like very aggregator first. So very Jupyter dominant. And EVMs and other chains, like you still have a bunch of front ends that still pull some of the flow away. On ETH and other L1s as well, you kind of have like multiple aggregators are not necessarily like a dominant aggregator landscape. There's also like a very different concept of MEV and the way that transactions are structured and the way that the block building process kind of works there. Solana, like one of the most interesting things as well in terms of like optimizing for pricing Oracle updates and things like that is like I was going into the ways that you can optimize here. It really is like a blockchain specific, Solana specific thing in terms of like the way that, some of these updates are processed and prioritized is actually based on kind of like fee per compute unit. And so like, it's not necessarily, and so that's just a way where like another one of those optimizations and kind of like iterations in terms of efficiency and kind of like the developer and architectural landscape there on Solana, like it's just an advantage. It's a fast blockchain. It's high throughput, low latency, et cetera, et cetera. And so it allows for market makers to have like this constant stream of pricing feeds and updates and things like that. And so in terms of like, would that ever get to another? Yeah, it's actually funny. There is a I think they're built on Sui and a couple of other ones, but there is a prop AMM that is on Solana that is publicly on other chains as well, and it's Obrick. And so they're on Sui. And so that's obviously like another high throughput, low latency blockchain as well. I'm not necessarily too well researched in terms of how dominant like the aggregator landscape is there. But those are a couple of the different reasons why the Solana market microstructure has like become the way it's become right now.
Do you think aggregators ultimately, this is the model where all DeFi trading is going to work, where aggregator dominant structures are where it's going to become?
From my perspective, like obviously you can see Hyperliquid, the L1, and like obviously see like massive amount of volume, massive amount of activity. Like everyone right now is trying to compete against Hyperliquid and things like that. And so that's probably like the other thing to think about is like, okay, if like you have your own, CLOB or something and it is just massively liquid, like literally everyone is trading there. I mean, at the end of the day, it's like, what do you want? You kind of want like the best prices for end users. You want, tight spreads, deep liquidity. And so like, do you get there through a CLOB? Well, yeah, you could get there through a CLOB if you just have like 1 million market makers on it, or all of the volume is on it, or everyone trades through it, which is kind of like what Hyperliquid is. Or if you have like a very market, you have a market microstructure where a lot of liquidity is potentially fragmented, where a lot of different, professional liquidity providers are active on the chain, like that's where it becomes like, okay, Solana is a little bit more of kind of like this aggregator dominated landscape. And like, do I think one is better than the other? Like it really starts to become also a question of what is better for end users. Would you want, it's like price discovery versus just better fills for the end user. Because at the end of the day, like the way that a lot of the on-chain trading on Solana works with these prop and dark AMMs and things like that is like an Oracle price that's coming from some of the most liquid venues off-chain. So like Binance, which would mean like, okay, price discovery is off-chain. It's not necessarily on Solana, it's on Binance because that's where the Oracle prices are coming into. But you could trade Sol USDC for way tighter than Binance. So like what actually ends up mattering to both market makers or users? Like for me as a user, I don't necessarily care too much about like the price discovery being on my venue or not. I just care if I go to, swap, I get the best fill. And so like for something like the Solana market microstructure, I don't know. Like there's a lot of different things to think about in terms of kind of like, price discovery versus better fills. Because like I described the prop AMM landscape, like the way that some of these Oracle prices are pulled is not necessarily on chain. It's off chain, most liquid venues, because that's where the price discovery happens. It's just things to think about there.
It's really interesting. I want to focus a little bit more about this comment you made earlier of how real traditional institutions are coming on chain, and you've kind of seen it in terms of more experiments now, in terms of like new issuance of wrappers coming on chain that are becoming tokenized in order to make it tradable, essentially, right? And you saw this with like Apollo ACRED, Moody's tokenizing some aspect of their business, the whole issuance of RWAs, and more recently you've seen it with like XStocks, right? With on Solana. I'm curious your thoughts on how a market maker's role evolves over time with the issuance of larger TAM assets on chain.
Yeah, that is a great question, because like one of the most interesting things at the end of the day is a market maker, a trading firm, like they're there to make money. And so essentially like you have this chicken and egg problem of needing to bootstrap volume and liquidity and activity of these novel assets, not necessarily novel, but new to traders on chain, right? Like I've never traded Tesla on chain before. I've done it on Robinhood. I've traded some call options and stuff like that, of course, but I've never done it on chain. And so you need to bootstrap like the volume, the activity, the open interest, like you need to actually bootstrap that. And it's the chicken and the egg problem that happens with literally like every DEX, like anything, any asset, right? Like it's like, okay, like if this thing was super liquid and I could trade in and out of it, I'd love to provide liquidity. Like this is like a great opportunity for me to like trade volume, clip spread, et cetera, et cetera. But what ends up happening is like you need to start thinking about how to incentivize like, liquidity, market makers, and things like that to actually come to some of those products. And so that's something in terms of like, how do I think about, how that will evolve or how that like actually plays out is probably like you end up having some like consortium of market makers or, active traders or users and things like that that are well incentivized to actually come trade some of these products. Because right now, like, would I trade, Tesla on chain? Multiple different things would go through my head before I said yes. It would be, okay, am I getting a better fill on chain than off chain? If no, okay, that's already kind of like, I don't know. But, it could be like, hey, I've got all my Solana, I've got all my assets on chain, so now I'll trade it on chain. Yeah. That's another thing to think about. But it's like, okay, even though I have like all this stuff on chain and I know I'm getting a worse fill, could I be incentivized? Like, is there an airdrop coming? Or is there something that this is launching on a certain protocol, or there's some sort of reward system or incentives, right? Like that, it's all about kind of like game theory and user behavior as well in terms of like incentivizing some of these earliest markets to become bootstrapped. And like, that's how you think about, DEXs. It's how you think about like a lot of the different stuff in DeFi is kind of like, okay, like everyone's got like a points program. Okay. So if I'm trading like some of these tokenized stocks, is there like a multiplier? And so like, there's a lot of different things to think about as a user, like not necessarily just even as a market maker, but as a user before I would even trade like stuff on chain. Like what do you guys think about there?
I completely agree. I mean, it depends where my assets are. And also it depends on the level of sophisticated user I am, right? Because ultimately there's probably an arbitrage opportunity early on with like XStocks and like trading it on like your general brokerage account now. I don't know what it would mean to me because I'm not that sophisticated of a trader, but maybe to you guys it could be very interesting. I'm not sure, maybe you're already doing this, but you buy Tesla because there's low liquidity on chain versus off chain, and I think that opens the door to many different like options of potentially using a stock as collateral on chain, right? Which could open the door to many different arbitrage opportunities.
Yeah, I was also going to say, so I mean, that opens up like kind of another point about the crypto market microstructure just in general in terms of like trading firms. Like there are some like 2 or 3 person trading shops where you look at the opportunities on chain, you're like, oh my gosh, I can make like 100K a month. And for 2 or 3 people, that's pretty good. They'll take those opportunities every day. Someone like us and someone, you know, like some of the larger firms, like we might not even look at that. And so it starts to become like, okay, like can we bootstrap this with kind of like these smaller professional market makers, these pro tail traders, things like that? Or does it really need to be like a larger institutional market participant to come onto these? Because a lot of the like whenever you actually look at some of the stuff on chain, and even whenever I was looking at it in like 2022, 2020, just as kind of like a retail user myself, like looking for arbitrage opportunities like you were discussing, it's kind of like, why is this here? Like, why is there free money? And then you start to look at it and you're like, oh wait, okay, it's because it's only in like, there used to be a website, I forgot what it was called, but it would actually highlight all of the like DeFi options protocols and show you kind of like, okay, which has the best price versus Deribit, because it was 100% just a free arb. But it wasn't necessarily like, maybe monetarily and risk-wise it was an arb, but time-wise, like whenever you actually traded the thing on chain, you actually had to like hold it to expiry until you could actually like convert or something like that.
Yeah,
and so essentially,
for a few $100,
exactly,
or maybe a few thousand.
Exactly. And so in terms of like size and activity, like, okay, a few thousand for a single trader, and it's kind of like, okay, I have to put up 5K and I'll make 3 off this. That's pretty good.
Yeah.
But for some like large institution, like they're not going to do that. And that's exactly why the arbitrage existed on chain for people.
Yeah.
And so like that's something to think about as well. And like even whenever you start to think about, you know, some of these wrapped assets and these LSTs and secondary market liquidity with minting and redeeming, like sometimes you'll be like, oh dude, free arb, like super easy. And you're like, oh wait, it's in size 2 Bitcoin. And you're like, oh shoot, okay. Like that's not something that we'd be like getting active on. But, you know, if it's something that we could automate, that's something that starts to become like, okay, like if we can automate something like this, or there's some sort of like fee incentives and things like that that allow us to get involved earlier, like that's whenever you start to see like, oh, like this is relatively easy for us, like we can just automate it.
Yeah.
And so a lot of different ways to think about like arbitrage opportunities on chain, because that's actually like, whenever I was getting into DeFi early on, DeFi Summer, et cetera, I advised a couple of dexes. Like one of the biggest things that they would always say is like, the way we're going to bootstrap liquidity is we're going to like depend on like natural arbitrage between other venues. And like you start thinking, you're like, okay, like if you have no size, you have no volume, you have no activity here, like this isn't just going to make activity come here. It's massively small size. Like maybe like a retail trader comes here, does the arb like a couple of times, but no institution's going to be here. And then you're stuck in the same problem.
Yeah. No, it's a really interesting point. I think one thing that's great about DeFi in kind of that same lens is like there is room for players like yourself to come in massive size arbitrage stuff and kind of do all sorts of market activities. There's also room for like the 14-year-old kid in some small country on the other side of the world, like who's like, oh, I can make a few dollars on this arbitrage, you know? Yeah. And that's really kind of cool about I think just the space in general. But you know, one thing that's really interesting that you've kind of touched on in a variety of different things we talked about is like just kind of from your firm's perspective, like time allocation, right? And like, you know, there's, I'm sure hundreds of projects launched every single day. There's, you know, hundreds of thousands of tokens launched on Solana every day. You know, like, and you guys obviously took the time to say, okay, we're going to work with Zenrock. We're going to kind of invest our time into this protocol. Like, what drives that decision, both kind of for us, but also just more, maybe even more generally, like when you're looking at different protocols to invest your time and effort in?
Yeah, I mean, specifically for us, it's like the multi-stage stuff, multi-pronged approach. Like I was saying earlier, like even whenever you think about the token market making business in general that everyone kind of does, right? Like there's like 30 plus, anyone can market make a token, it seems like. Like whenever we think about it, we actually think of like the token market making deal as potentially like the icing on the cake. Like before we actually get to that stage, we're actually actively discussing what else can we do with the protocol. Because fact of the matter is, like, whenever you start to think, okay, there's 30 other people who can market make the token, like what does that end up being? It just ends up being a competition to who can charge the cheapest for the same liquidity KPIs. And whenever you start thinking like that, you start to kind of like, you know, commoditize liquidity like that, and then you really need to start thinking like, you know, from the BD side, like, okay, how can I get extra value out of that deal? And it's usually helping the protocol in other ways. And so like one of the biggest things that we do ourselves in terms of like thinking how we allocate time like to the client facing business, because we also have kind of like, the active high frequency business where we're kind of like, playing with the prop AMMs and doing SEX-X-ARB and DEX-DEX-ARB, et cetera, et cetera. We have kind of like the liquid and discretionary DeFi business where it's like, okay, we're monitoring systematically a bunch of different LSTs and pegs and being able to defend pegs and like, mint and redeem for arbitrage opportunities. We've got that, TVL and things like that. Like we started to think about all these different things that we can kind of do. And so a lot of the different protocols that we're actually working with right now, we're doing multiple things with. So whether that is kind of, market making the token, but also kind of like, hey, some sort of like minting and redeeming arbitrage or a TVL kind of agreement or something like that in terms of just actively getting involved with the protocol. Like one of the things about us as well is like, we're actively either co-building, like one of the things that we're doing right now as well as building a Solana perp DEX. We're going to be doing that ourselves. And so that is something to where it's like, we have like the developer and the builder expertise. We're also a high frequency trading firm. Like if you are building a product in DeFi and you need someone to tell you like what would be important for a market maker to see in your product for us to actually use it, like we can give some of the best product feedback and advice because we would be the market maker who actually uses it, right?
Yeah.
Right. And so like that's something as well as like a lot of the product stuff that we've done for, some of these people has been, massively valuable. They're like, oh, I'm talking to a bunch of market makers, like I want them to do X, Y, and Z. What would incentivize you guys to do X, Y, and Z? And it's like, oh, okay, like if you offered some sort of like rebate here or like you offered some sort of like incentive in this way. Because like one of the things that, even just being like an advisor for some of these other protocols myself is kind of like, okay, how do you incentivize, very specific user behaviors, like whether that is TVL or whether that is volume or open interest or like, liquidity and activity in the tail assets. Like just advising DEXs, like one of the different things in terms of like designing a points program or designing incentives is kind of like, okay, like it obviously makes a lot of sense to talk to either a trading firm or a previous trader in terms of like what would make me do what you want in terms of like, okay, if you need liquidity in, not Bitcoin, ETH, and Solana, like obviously the blue chips, the majors, typically like the deepest liquidity on any venue, but like, some of the tail assets, whether it's like Fartcoin or like some of these other, altcoins on different exchanges, like what would make me do that? And so, going off on a tangent and kind of a ramble here, but the TLDR is kind of like, the way that we work with protocols and projects is how can we add the most value to you? And like, we're very, very, very knowledgeable in terms of like what we need to actually like add the value and bring that to the protocols.
Right.
It makes a lot of sense. And I do agree with you in terms of a multi-pronged or multi-staged approach with any project in the on-chain economy or in DeFi. I mean, that's one of the things that's very core to our thesis, right? We're starting out with ZenBTC, but we also have our own chain that is like a special purpose chain that gives you permissionless access to the MPC that's completely open, decentralized, and permissionless. So any developer could really use that to control keys on Bitcoin or on Ethereum or on Base and also build an application on Solana. So kind of view ourselves as really this open cross-chain signature protocol that enables you to do multiple things outside of just launching ZenBTC, which was something that we did initially to just start out building the foundational liquidity.
Yep.
One question really I have for you, a little bit more macro, because I think we went through a lot of microstructures, which is super interesting. But you're starting to see a lot of consolidation in the space. M&As, I think, at an all-time high now. Obviously, you've had the acquisition of Deribit by Coinbase.
Yep.
But as you see trading venues and infrastructure getting a bit more mature, how do you see consolidation evolving as it relates in terms of comparisons from DeFi and CeFi? Do you see like DeFi, ex-DeFi equity or cash transactions happening more and more? Or is it more of a CeFi or centralized or traditional player acquiring a DeFi infrastructure business in order to onboard a new crypto strategy?
Yeah, I mean, I think from my perspective, like there's actually a historical one that's happened, I think, within the last year, but it was more of kind of like an acqui-hire situation. I forgot what it was, but I think someone acquired Sega, the on-chain options or exotic options protocol. I think it was kind of like an acqui-hire situation. In terms of like CeFi businesses with M&A and activity there, like I'm trying to think, from our perspective. So we built Hashnote, and Hashnote was acquired by Circle.
Right. Yeah.
And so just thinking about it, obviously you said Coinbase and Deribit. And so there's actually, I mean, obviously a massive amount of kind of like these CeFi businesses acquiring, or traditional businesses acquiring more of these like CeFi crypto businesses, I would say. from my perspective, like I think that trend will continue to happen. I think if you zoom out from like the Solana, you zoom out from the DeFi landscape and you take like a bird's eye view at what's going on in crypto right now, like the most interesting thing on the institutional side is probably, more of the boring stuff. It is like these stable coins, and it is a lot more in terms of kind of like the revenue generating businesses there, which is obviously is like very attractive to traditional players. They actually are like, oh wow, you generate revenue. Like there's stuff like that, as opposed to like some of the stuff in DeFi recently. But like, to answer your question, I think a lot of it will continue like traditional financial businesses acquiring more of these kind of like CeFi entities, CeFi players. In terms of like acquiring the DeFi businesses, like I think that would be a massive kind of thing to see in terms of like that's massive signal in terms of like if you saw like a traditional business acquire DeFi, like I feel like there's obviously a massive amount of, things to think about, because for that to happen and for a traditional business to be okay with actually doing that, there probably needs to be a lot of things that happen behind the scene in terms of like regulatory and all of that to line up and get something done. Like we obviously see kind of like the frameworks for ETFs being issued and all of that. So there's obviously a lot of this stuff in the US that's like relatively, starting to become conducive to potentially thinking about things like that down the line. But right now, I think that would be a massive thing if kind of like these traditional, not necessarily CeFi business, but like traditional institutions start like looking at DeFi for M&A.
Well, I think it's a huge point, especially on the talent side. Like acquiring this level of knowledge of like a deep niche sector in DeFi is so hard for a traditional institution to do. It'll take them years to do that. So acquiring talent, I think, is going to be a huge theme over the next like 24, 36, 48 months, especially as TradFi gets in. Yeah,
I mean, as every single major financial institution realizes they need to be operating on chain, not like through a SEX, like on chain. They're gonna have to be like, okay, who's gonna do this? Like, it's not gonna come from internal, right? You're gonna need to find the people, and I think Toddy's point, like it's gonna become cheaper for a lot of these larger companies to just say, all right, I'm just gonna buy this company.
Exactly.
You forget about the protocol, keep the protocol. You know what I mean? Like, but it's just about the actual individuals. And so I agree, that'll be really interesting. One kind of like new DeFi project that we just integrated with is Project Zero. In terms of DeFi, I always get really excited as someone who previously also worked in trading. Like when I see something where I'm like, wow, this is actually new, because we see so much of like kind of, take launch pads or whatever else. Like there must be 80 at this point, on Solana alone. And like, all these other kind of things like that you just see everyone just kind of copying over and over again and trying to put small spins on, but just see something that's actually like kind of fundamentally different is really interesting. So what they're doing is like kind of on-chain prime brokerage. And the point is like that you can have assets on one venue and then go and use that as collateral on a different venue, which is massive in the traditional world, especially like in traditional trading and arbitraging, and kind of makes a lot of these trades that we were talking about earlier about like, spreads on something like Deribit, makes it a lot more attractive if you could actually turn around and say, okay, let's say this other venue has different pricing on the options, and instead of arbitraging needing to put up the capital twice, you can put up the capital one time and use that as collateral for your other trade. That makes everything way more attractive, and the kind of amount you need to make on it a lot lower to make it attractive. So, ZenBTC, we launched as kind of one of their launch partners, and there's an incentive program right now to kind of bootstrap liquidity on the platform. So it's worth checking out. Really excited to kind of see what those guys are able to do and kind of how that changes the on-chain trading landscape. But I guess, for you, like, how do you think that will change the on-chain trading landscape?
100%. Like one of the biggest things in terms of how it's described, and just looking at the project and protocol as well, is kind of like some of my previous experiences, like the cross-chain arbitrage stuff. Like that will start to become a lot more interesting and a lot more active. Like right now we're super active on Solana, but if we can use like, some of our collateral on Solana to go take advantage of stuff, on Monad whenever it launches, or Hyperliquid and stuff like that, right? Like that's something to definitely think about. And whenever you can start opening other venues and other, like I said, whenever you can start opening up these opportunities on other venues, like regardless of chain, like that's whenever, you start to get even tighter prices and spread and liquidity, et cetera, et cetera. cetera. You think about it exactly right now in terms of like sex arbs, in terms of like, you know, some of the CeFi venues, like being able to arb, you know, Binance versus Coinbase or Binance versus like any of these other venues, like being able to use like some of these exchanges and venues that, you know, have some sort of deep liquidity already, is kind of like a way to, you know, be the hedge leg for something on a chain that might not have the most liquidity.
Right.
Like that starts to become like, oh shoot, it actually makes sense for me to take advantage of the, you know, this $100 arbitrage or something like that we've automated, because now that collateral can actually still be used across other chains and other trading activity. So yeah, that makes a lot of sense.
Totally. And I think, you know, we talked earlier about like this idea of the arbitrage size kind of, there's users at every size arbitrage, and now unlocking kind of prime brokerage for every user on chain totally opens up those smaller arbitrageurs who couldn't go to a traditional prime broker and open an account and get, you know, this type of capital. So I think it's really great. I think it'll make the kind of spreads tighter and the ecosystem healthier across the board.
100%.
I think as we're wrapping up, like one last question I'd love to bring up is kind of, if we were doing this podcast in a year from now, what do you think is maybe one trend or one theme that is on nobody's radar right now that would be kind of all the rage?
One trend or a theme that's on nobody's radar. I think, you know, one of the most, like, if you look at crypto Twitter right now, like we're seeing a massive amount of like everyone launching a perp dex and everyone's doing their own perp dex. We're also about to do our own as well. And so like in a year, I'm actually going to be curious what the competitive landscape looks like for these, because you start to have like, okay, other high frequency trading firms are incubating perp dexes. You have other teams who already have like a massive amount of active liquidity, like coming on and incubating perp dexes. You have other like, you know, teams who are very specialized in like distribution in one part of the world that got a massive amount of users. And now they're pushing more towards like Western marketing and acquiring these users. Like in 1 year, it's not necessarily like the most. Actually, I still think it is probably one of the more interesting things to think about is like, what will the landscape for on-chain trading as well as kind of like trading in general look like in 1 year? And like with all these people launching their own perp dexes, I mean, like you can even break it down into like, should it be its own chain? Should it be its kind of like, you know, composable ecosystem built on another L1? Like what's going to be like the landscape of on-chain trading and activity in a year? Because like with what we're seeing right now, like in terms of how like quickly, you know, some of the volume and open interest and like some of the activities actually spinning up on these perp dexes, you know, regardless of if it's just being farmed or if they stay there, et cetera, like mercenary liquidity, all of that stuff popping up. It'll be super interesting to see, like, is Hyperliquid still number one in a year? Like, I would lean towards most likely still in a year. But, like, it'll be super interesting to see who's number two and, like, who else is competing in that space for sure.
Well, I think that's super interesting. And we often talk about, you know, where moats sit in the on-chain economy. And historically, perp dexes specifically have not been able to retain market share and have moats. So it'll be really interesting to see where it evolves over the course of the next 12, 18, 36 months as well. So thank you so much for coming on ZR Talks number 8, and looking forward to continuing our partnership.
Sounds good, guys. Thanks for having me.
Yeah, thanks.